Market jitters rise as U.S. unemployment inches higher. What's next? The latest data from the U.S. economic calendar has revealed that unemployment rose from 4.0% to 4.1%, sparking mixed reactions across financial markets. While the increase may seem marginal, the market's initial response suggests a nuanced outlook on the American economy in the coming weeks. First, market reactions: cautious optimism. Upon the release of the unemployment data, the market's immediate movements were largely positive. Two-year bond yields slightly decreased, indicating investor confidence in potential rate cuts. Interest rate cut expectations remain steady, with 3 cuts still priced in for 2024. Notably, the likelihood of these cuts increased slightly, reflecting the market's belief that the Federal Reserve may lean toward easing monetary policy. The DXY, US dollar index, experienced a slight decline, while euro to US dollar rose, showing mild dollar weakness. VIX, volatility index, also dipped, suggesting a sense of calm despite the uptick in unemployment. Neutral data with positive implications. Despite the positive market reactions, the data itself sits in a neutral range. The unemployment rate remains below the Federal Reserve's projected median level of 4.3% for 2024, a threshold that would indicate more significant labor market weakness. This gap suggests that the current labor market is still resilient, albeit showing early signs of softening. Scenarios for the upcoming weeks. Looking ahead, several key scenarios could unfold. Soft landing narrative strengthens. If unemployment continues to rise at a gradual pace without a sharp slowdown in job creation, the Federal Reserve may feel more confident in cutting interest rates without risking a recession. Inflation-driven hesitation. Should upcoming inflation data remain sticky, the Fed might delay rate cuts despite rising unemployment, a scenario that could frustrate markets. Labor market shock. A sharper than expected increase in unemployment could trigger a more aggressive rate cut cycle, boosting risk assets but signaling deeper cracks in the economy. What to watch? Upcoming inflation reports. The Fed remains highly sensitive to inflation data, which will likely dictate the pace of rate cuts, jobless claims, and wage growth. Any spike in weekly jobless claims or a slowdown in wage growth could reinforce expectations for rate cuts. Global economic developments. External factors, including China's economic slowdown and geopolitical tensions, could further influence market sentiment. While the initial market reactions appear positive, the coming weeks will reveal whether this unemployment data signals the start of a broader slowdown or simply a temporary blip. Experienced economists will be closely monitoring how the Federal Reserve navigates this delicate balancing act between controlling inflation and supporting the labor market, a decision that could set the tone for the rest of the year.